Ladies and gentlemen, good day and welcome to the post-PVR-Inox merger call hosted by Axis Capital Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ankur Periwal from Axis Capital. Thank you, and over to you.
Thank you, Yashashree. Good evening, friends, and welcome to PVR-Inox Limited's post-merger conference call. The call will be initiated with a brief discussion by the combined management of PVR-Inox on the merger, followed by an interactive Q&A session. Management team will be represented by Mr. Ajay Bijli, Managing Director, PVR Limited, Mr. Sanjeev Kumar, Executive Director, PVR Limited, Mr. Nitin Sood, Group CFO, PVR Limited, and other members of the senior management team. Over to you, Mr. Bijli, for your initial comments.
Thanks very much. Good afternoon and welcome everyone to our analyst investor call. I'm delighted to update that we have successfully completed all formalities relating to the merger of Inox with PVR within record timelines. The new PVR shares issued to Inox shareholders have already started trading from yesterday. The coming together of PVR and Inox brands marks an exciting chapter in our journey and creates the largest film exhibition company in India with 1,674 screens across 358 properties in 114 cities, India and Sri Lanka, and an aggregate seating capacity of 3.56 lakh seats. We are confident that this merger will allow us to better serve our customers, expand our reach, and create new opportunities for growth. Moving forward, as the appointed date is fixed as 1st January 2023, we will be reporting combined financials along with the audited results of Q4 FY23. Our focus for the next few months will be to successfully integrate the two businesses and realize the anticipated merger synergies over 12 to 24 months time frame. This will require a lot of hard work and dedication, but we're excited about the opportunities that lie ahead. We've engaged Korn Ferry, a leading HR consultancy firm, in assisting us with the HR and cultural integration. We've announced a day one organizational structure. I will lead the company as a managing director, and Mr. Sanjeev Kumar, my brother, has been appointed as the executive director. We will be supported by the following leadership team from both PVR and Inox. Mr. Alok Tandon, Co-CEO, Central, East and West regions. Mr. Gautam Datta, Co-CEO, North and Southern region. Mr. Nitin Sood, Group CFO. Mr. Kailash Gupta, Deputy CFO, PVR Limited and CFO, PVR Pictures. Mr. Kamal Gyanchandani, Chief Business Planning and Strategy Officer, PVR Limited and CEO, PVR Pictures. Mr. Pramod Arora, Group Chief of Growth and Business Development. Mr. Reno Pallier, CEO, The Luxury Collection. Mr. Jitendra Verma, Chief Information Officer. Mr. Rajinder Singh Jyala, Chief Programming Officer. Moving on to the content side, we recognize that 2022 was impacted on account of underperformance of Hindi films and lower number of Bollywood film releases. Last year, the Hindi film industry experienced a turbulent year with significant fluctuations in box office collections. The focus has shifted towards the content quality rather than solely relying on presence of stars. There is now greater acceptance of multi-language content with pan-India releases in multiple languages becoming the norm. This trend is a positive development for the industry as it opens up new markets and audiences while also encouraging filmmakers to prioritize content quality. The lineup for 2023 is looking very promising. We have big release slate for the next 12 months across Hindi, English and regional films. From Hindi, after the huge success of Pathaan, we have two more movies starring Shah Rukh Khan releasing this year, Jawan releasing in June, and Rajkumar Hirani's Dunki releasing on December 23rd. We have two big movies starring Salman Khan, Kisi Ka Bhai, Kisi Ki Jaan in April, and Tiger 3 in November. We have two Ajay Devgan movies, Bhola in March 23 and Maidan in May 23. Other big movies from Bollywood include Bawal starring Varun Dhawan in April 23, Adipurush starring Prabhas and Saif Ali Khan in June 23, Satya Prem Ki Katha starring Kartik Aaryan and Kiara Advani in June 23, Dream Girl 2 starring Ayushmann Khurrana, June 23, Yodha starring Siddharth Malhotra in July 23, and Animal starring Ranbir Kapoor in August 23. From Hollywood, there are several tentpole planned for release. 2 movies from the Marvel Comic Universe, Guardians of the Galaxy Volume 3 in May 23 and Marvels in July 23. Three movies from the DC Comic Universe, Shazam, The Fury of Gods in March, The Flash in June, and Aquaman and the Lost Kingdom in December. We have sequels from super hit franchises like Fast and the Furious 10 in May, Transformers, Rise of the Beasts in June, Indiana Jones and the Dial of Destiny in June, Mission Impossible, Dead Reckoning Part 1, July 23, and Dune 2 in November. Other notable releases include Christopher Nolan's Oppenheimer in July. Regal Cinema 2 has some strong releases. Jailer with Rajnikant in April, Bhola Shankar starring Chiranjeevi in April, Salar starring Prabhas in September, PS2 in September, Leo starring Vijay Thalapathy in October, Indian 2 starring Kamal Hassan in October, amongst others that will get released during the year. Looking ahead, we will be opening 180 to 200 screens every year over the next 2 years across strategic locations in key markets. We are confident that PVR-Inox will continue to grow, innovate, and reimagine the movie-going experience to make our brand aspirational and accessible. We believe that the future is incredibly bright, and we look forward to sharing our progress with you over the coming months and years. Thank you once again for joining us today.
Yeah, you can begin with the...
Yes. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Abneesh Roy from Nuvama Institutional Equities. Please go ahead.
Yeah, thanks and congrats finally on the full merger. My first question is on the SPH, wherein you have highlighted that in India you are still at 51% versus global average at 70%. You have already been doing very proactive work here. Going ahead, what can be the differentiated factor here? I understand the non-veg bit, I understand the home delivery bit. My question was more on the home delivery and the free ticketing. How big is the opportunity? Because you have given the data versus rest of the QSR. Lot of your consumption here is because of the captive audience. So beyond your captive audience, how big is the opportunity? Because your pricing versus a normal Zomato offering or the Swiggy offering, the pricing is a big challenge, right? So are you doing some proactive work in terms of the pricing bit? The home delivery?
So actually, there is... Hello. Yeah. So this idea came up during COVID, and we've actually worked extensively to get a new menu, a new brand on Zomato and Swiggy, which actually in terms of pricing was extremely market competitive. So we are not selling the F&B products at the cinema pricing, but it is very, very competitive with that. Having said that, this merger sort of gives a much larger footprint to this idea. Now we can actually try this experiment across many more locations. And these are kind of early days. We are also learning this new way of doing F&B business. This is great incremental food business for the cinema, but it will take some time for us to make it more sizable as an independent entity. But more locations means more delivery and being able to sort of feed a larger consumer base.
No, but my question was... Yeah, sorry.
Then, go ahead, please.
So my follow-up question there was, say, internally, I'm sure now with merger done, would you have a number internally that, okay, 3 years, 5 years down the line, home delivery bit or whatever you mentioned of a separate brand with a much more affordable pricing, do you have a number on that at least internally that this percentage of F&B revenue has to come from there? And are you doing, for example, cloud kitchens in a big way? or is it being largely done through your own stores currently?
So it's currently all being driven out of our cinema. We've taken an outside view that technically 5% of the SPH contribution should eventually come from such an initiative. But as I said, this is going to be a couple of years down the line that when we can get there. But to your point, did we take a target? Yes, there was. And for each cinema, and we've got not one location technically in a certain location. So every 5 kilometers there could be a cinema, and every cinema would possibly have a micro target where we will like to contribute at least 5% of the cinema SPH coming out of a home delivery. But as I said, these are early days and we are kind of consolidating and learning as we are moving forward on this.
Sure. My last question on the F&B aspect is, you have a 20% gap or 90% gap is versus the global average. If you see, general customer perception is that already popcorn and cola and all products in your multiplex is quite expensive, and you're already sweating the current real estate within the multiplexes quite well. How does that gap bridge? Is this gap more because of the per capita income what India has? So whenever that per capita income goes up, then this gap can be bridged, because this gap is a big gap, right? 70% of ATP international average.
But that's a positive, isn't it? It shows you that there is headroom to grow, and so it will be delivered by volume rather than value. We still believe we can improve the strike rates. We still believe that we can improve the variety of offerings. We're also looking at not necessarily selling everything post-ticketed. We're also looking at pre-ticketed. Now, that pre-ticketed doesn't mean only home delivery. Pre-ticketed also means that you can enter the premises and buy concessions. A lot of our cinemas don't allow entry, unless you have a ticket. Now, we're planning to open up a lot of cinemas as well, so that even people who have not come to watch a movie, they can also buy some of our USP products. So there's a lot of strategies that we have in mind. Some of the box offices are getting converted because a lot of tickets are getting sold online now. So a lot of real estate is dedicated to box offices. We don't need such large box offices. So some of them are getting converted to, and we've already done those pilots. In Ambience Gurgaon also we've done it, where the concession stand is also opening outside, and some of the box offices are converted into F&B outlets. So I think there's a lot of initiatives being taken to take this up further.
Sure, my last question is essentially on the cost and capex bit. You have mentioned capex will come down by 10 to 15%. Wanted to understand that, is it just because of economies of scale, because already PVR itself was very large, right? Inox is adding more to that, but still want to understand that bit. And second is EBITDA synergy of 225 crores. What are the low-hanging fruits here? You have mentioned 12 to 24 months, and you have mentioned 3-4 factors which will drive this. What are the low-hanging fruits here, and in terms of quicker turnaround?
Nitin, you want to talk about the low-hanging fruits?
So, Abneesh, like you said, we started work on the synergies very recently. The teams have started to get together. I think the big focus area will be to drive the revenue synergies up. F&B is going to be one of our large area where I think the focus is going to be to drive long-term synergies. There is a difference in the SPH levels between both the circuits. How do we bridge that? That's going to be the big focus area. Obviously, box office synchronization of programming across common circuits where we have, cinemas for both PVR and Inox. How do we synchronize programming to ensure that we have shows which are complementary, which give opportunity to consumers to watch a film every 20 minutes instead of competing on show times? How do we ensure we synchronize pricing and not compete in some of those common circuits? And advertising revenue. I think these three big revenue pickers are going to be there. I think on the cost side, our big focus is going to be supply chain. I think both the teams have done a lot of work on cutting down their independent costs during the pandemic. So from here on, I think the focus will be to get supply chain synergies given the size and scale and the volume. F&B COGS, reduction of F&B COGS, given the significant volume of buying that we will do. Any duplicate overheads, which we can immediately rationalize will be the quick wins. Balance of the stuff will take some time. We will also, that's the reason we've guided about a 12 to 24 months of effort before we realize the full potential synergy. But hopefully later part of the year, we should start seeing some of the synergies playing out.
Sure. Thanks a lot. That's all from my side. Thanks a lot.
Thank you. We have our next question from the line of Jinesh Joshi from Prabhudas Lilladher. Please go ahead.
Yeah, thanks for the opportunity. Sir, I have a question on the cost synergy bit which you just highlighted earlier. So in terms of avoiding duplication of work, which you just mentioned, what all areas have we identified? Maybe we may not need two teams for programming or for that matter, even for negotiating with the mall owner. So basically, any specific area that you would want to highlight over here, which can result in decent amount of savings due to employee redundancy?
No, not really. We won't want to highlight. We started work. I think it will require a great amount of organizational effort between both the companies to integrate both the organizations. I think for us, that's going to be the big priority right now. Integrating, we both operate on different technology platforms, different ERPs, different operating systems. So I think next 6 to 9 month effort will be to try and integrate and put everything on a common platform. Post which some of the synergy integration will play out, faster. No specific guidance on any specific area as such. I think we started work. I think we believe there will be savings in each element of cost, but it's slightly premature for us to comment, on anything specific right now.
Sure, but will the benefit be front-loaded in year one, or will it take some time to realize? That's the follow-up. And secondly, also I would like to know when does our term with BMS and ATM end, and also for Inox. And secondly, with respect to that, unless that term ends, there will be no upside from bridge negotiations, right?
Sorry, I'm not able to hear you clearly. Your voice is breaking in between.
So what I was saying is that will the benefit accrual for synergy will be front-loaded in year one or year two? That is one. And secondly, I also wanted to know when does our term end with BMS and PGM, and also for Inox?
Okay. So on question number one, like I guided earlier, we think it will be a 12 to 24 month effort to realize the synergies. No, I don't think there will be front loading of the synergies. It will take minimum 5 to 6 months of work before synergies start reflecting in. So yes, there will be some part of the synergy of the 225 crore annual synergies that we've guided, which will flow in year one. But exactly what that quantum will be, I think as we go along during the year, we'll be in a better position to guide. But some of these synergies will move into next year. As I said, there is 6 to 8 months of work involved in putting a lot of stuff on the ground, actionable condition, before those synergies start reflecting. On your second question, on our contracts with online aggregators, PVR's existing contract ends in end of April, and Inox's existing contract ends end of March. End of March 2024, sorry.
Got it, sir. Thank you so much, and all the best.
Thank you. We have our next question from the line of Arun Prasad from Avendus Spark. Please go ahead.
Thanks for the opportunity. Some of the questions on the quantification of the synergy, I think, covered already. I would like to focus on some of the qualitative aspects of the synergy. Like probably today we are not able to quantify it, but it will generally give us a positive EBITDA probably over 5 to 6 years. What are those things which is currently we are not yet quantified, but something which we are working, if you can highlight it, some of them will be great.
No, I didn't get your question fully. Can you once again repeat? When you say qualitative aspects of the integration?
Of the synergy benefits. Basically, we have quantified. Some of the things which we can quantify, probably we have done it. For example, I don't want to say example, but to put it in a words, say, extension of the OTT windows or some of the things that, probably you can do with the mall developers. Anything else apart from this which you can know, which is a long-term kind of a merger synergy that we should be aware of?
Yeah, I think the focus will be with the combined size and scale to work on all areas to improve the operating efficiency of the circuit that we have, and that would relook at some of the existing contracts, etc., and practices we have. It will also include relooking at our capex outlook in terms of average per screen spends. It will also look at figuring out a way to better manage our rental costs, try to make more and more variable costs, and reducing capex intensity in the business as we move to more tier 2, tier 3 locations. So all of that will be part of the long-term strategy and the plan. But like I said, it's still early days. We will be working on a lot of it, and maybe in next 3 to 6 months we will be in a better position to share a lot more as we work together on the combined entity.
Okay. Actually, specifically, I would like to ask something on the OTT window. Is there any, beyond a certain days or weeks, is the benefit of extending the window is there, or it stops at certain level, say 6 weeks, 9 weeks, or 3 months? What is our current view on this?
So our current window for Hindi films, which is predominantly the content that we play in our theaters, is 8 weeks. This is the same as the window that used to exist pre-COVID. Currently, both the content creators and exhibitors, which is PVR-Inox, we are comfortable with this window. The same window applies to Hollywood films. In fact, the Hollywood films, the window tends to be a little longer because the Hollywood films come from the studios mainly, and these studios tend to follow the international windows, which are usually longer than 8 weeks. As far as regional films are concerned, the other non-Hindi Indian films, Tamil, Telugu, Malayalam, Kannada, Marathi, Punjabi, we play films in almost 12 languages. Windows vary from 4 to 6 weeks. It's our endeavor to push these windows towards 8 weeks, but we would not like to make any sort of firm we'll not like to make a firm specific window, spell out a firm specific window at this stage. But the endeavor for this year remains that we would want to sort of increase the windows for the non-Hindi Indian language films.
Okay. Actually, I was asking specifically beyond 8 weeks, is there any benefit, or you don't tend to see any benefit on the falls or occupancy in multiplexes?
It's a bit of a subjective issue, and for different films the answer would be different. But for bigger films which show longer legs at the box office, yes, the longer window is definitely beneficial. But you have to appreciate it's beneficial to both parties, right? Even the content creators benefit from a longer run if a film is having a long run at the box office. So therefore, quite often we find that the content creator is more than comfortable to increase the window for a big film, especially the ones which are doing well at the box office. So yes, the answer is yes, we benefit from a longer window, especially for bigger films. But more often than not, it's the content creator who's forthcoming with a longer window.
But can the content producer change it after the release of theatrical release? Isn't it already agreed between the OTT before the release itself regarding the window?
Yes, they can. The content creators tend to have considerable leverage with these streaming platforms, and in a counterintuitive fashion, even the streaming platforms benefit from a longer run of a film at the box office. So quite often even they are comfortable to increase the window.
Okay, understood. Okay, my second question is on the now that we have a stronger balance sheet, are we thinking of anything about smoothening the volatility on account of depending on this content? Can we do something related to reducing the volatility, content volatility?
No, we are constantly in dialogue with the content partners, requesting them, informing them of our trends and various data points that we are monitoring and collecting, to ensure that content creators make more films for theaters, and they also continue to release them in a steady fashion. So there is a constant dialogue on this front. As far as volatility of performance is concerned, our business, the inherent DNA of our business is peaks and valleys. So, while we as exhibitors and content creators, producer, distributors, all of us want more consistency, but the fact remains that this is not a business that we can see on week-to-week basis. We have to see it on a slightly longer duration. But our experience has been that when you see it for a slightly longer duration, things tend to even out.
All right. Very helpful. Thank you for this.
Thank you. A reminder to participants to press star and 1 to ask a question. We have a next question from the line of Girish Pai from Nirmal Bang Equities. Please go ahead.
Yeah, thank you for the opportunity. This number of 180 to 200 screens seems a very large number considering the low occupancy levels we've had in the last 9 to 12 months. Do you think the new screens are cannibalizing your older screens? And do you think you can work with a slightly lower number of new screen openings? Just, before you kind of go more aggressive on that, before you to see that your occupancy hits a certain decent number of 35 plus thereabouts, which you did achieve in the past?
See, it's only been, it's only been 12 months since we have opened after COVID. So, it's too early to take these occupancies as the normal settled occupancies with this business and what we've been attracting over a period of time. And these decisions have been taken where it takes about 4 to 5 years for 3 years minimum, maximum 5 years for a mall to come up. So these decisions were taken earlier. Plus all the projects that we sign and the screens that we open are very carefully selected in terms of what are the market gaps where a product like PVR or Inox is not there, which are the malls which are being developed by quality developers like Phoenix or DLF or Lulu or Prestige. And these are all destination malls in catchments and cities where there is no presence of high quality cinema viewing experience. So this 12 months is too short a period for us to start having palpitations about our business. We are comparing 80 years of pre-COVID period to 12 months of post-COVID period. It's too early to draw any conclusions. We believe in the long-term, prospects of this business, and we believe that all these screens are in great locations. Quite a few of them are in South India as well. In fact, the ones that we've opened, quite a bulk of them are in South India as well. Where again, the multiplex penetration is very low. Still, there are a lot of single screens there. But now, mall developers are building shopping centers and malls in a lot of these towns in South India as well. And that's where PVR or Inox becomes an integral part of attracting footfalls. So this is not just capex being done without any thought. Each and every property has a return criteria. Each and every property has a qualitative criteria before we start investing capital. Plus also these projects have got bunched up together because for a long time, the activity has stopped. And now, ever since, the world has opened up, the malls and shopping center construction has also expedited. New retail formats are coming up. existing retailers are increasing their footprints in the malls, and new brands are coming up every day in the country. And in fact, the footfalls are increasing in all the malls as well. Offline sales are better than online sales now. PVR is very much, PVR and Inox are pretty much part of this upward trend in the shopping center development.
Okay. My next question has to do with the synergies. It's interesting that you mentioned that F&B would be the key one to focus on. I thought probably advertising would be the easier one to kind of an easier win to get, because there's a fairly large difference between the Inox Leisure, erstwhile Inox Leisure ad revenue per screen versus the PVR ad revenue per screen. So wouldn't that be an easier win for you to get compared to F&B?
Yeah, Gautam I'll let Gautam answer that. Gautam?
So actually, advertising, definitely a lot of work needs to be done, and we are very, very confident that coming together of PVR and Inox is going to really open up the market for us. There is definitely some amount of low-lying fruit in terms of price correction and discounting correction that could happen. But having said that, we are just waiting for a couple of movies back to back to start doing well. We got a lot of advertisers back during Pathan and now with Ranbir Kapoor film. Even South has seen an influx of all the large advertisers coming back. They are now definitely showing interest. I think the journey of getting synergy numbers is definitely on the cards, and I believe within the next quarter or so, these synergies would start trickling in. But it will be largely the H2 of this year where we'll be able to start scratching the surface and getting ready for the big bang numbers.
Okay, my last question is to do with the per screen fixed cost structure. How do you foresee that going forward? In which particular, spend head do you see cost kind of coming down on a per screen basis?
It's too early for us to comment on anything. I think at this stage, like I said, bulk of the savings, if any, will be on removing duplicate costs and getting the supply chain benefits. At cinema level, I don't think there is any material difference in our cost structure. But I think in corporate and regional costs, as we integrate the organizations, there will be some savings. But the big focus area right now, I think in the next 9 months, is to integrate the organizations right, given the complexity involved. And, the synergies will follow post that.
Okay, and one last question, if I can squeeze it in. Any specific item on the balance sheet which comes out as an adjustment or some extraordinary item which one should be aware of post the merger?
On the balance sheet?
Yeah, right. Is there any goodwill or...
transaction-related costs? There will be some stamp duty costs which will be one-off, which is relating to the transaction. Nothing else other than that. I think both the organizations have been running. And, we will, as we announce the numbers for this quarter, obviously there will be, synchronization of accounting policies, restatement of some of the balance sheet items to bring them to common accounting principles. That's about it, which is required, which is typically a part of any merger exercise, but nothing other than that.
Okay, thank you.
Thank you. We have our next question from the line of Ali Asghar Shakir from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity. I had a question on our occupancy. So, last couple of quarters, we noticed that discretionary spends across, multiple states have been pretty weak. Do you think that would be a reason because of which our occupancies may have got impacted? Now, I understand that some of the movies have done very well, but then, maybe frequency of, the falls is what maybe gets impacted probably, and therefore it gets bunched up into specific movies that do very well. So, any any thoughts on particular states that may have done well or not done? If you could share any color through your surveys that you may have done.
It's generally it's said about the entertainment business that this is a recession-proof, cricket-proof business. And we, genuinely believe that that statement is true because when we look at, we have this one property in Sri Lanka, and Sri Lanka is a known fact has gone through some serious financial crisis. But the numbers that we've seen in the calendar year 2022 have been the best numbers that we've had in Sri Lanka property, although it also opened in 2019, so there is not much of history. But what I'm trying to say is that in spite of a very deep-rooted financial crisis, cinema has continued to perform in a fantastic fashion. In India, I think the problem has been more to do with the number of Hollywood films. There was a reduction in quantity, and definitely there was a decline in the performance of Hindi films, which is staple diet as far as pan-India national chains like PVR-Inox are concerned. Also the mid-level films, films which were doing 50-60 crores of box office, they showed underwhelming performance. But like I mentioned earlier, our business has seen these sort of phases earlier, and also let's not forget that COVID was one of the biggest break in this habit of movie-going, cinema-going that we've had in this country or anywhere else in the world. And cinema-going is a habit. I mean, bulk of our business comes from people who come back to theaters frequently, watch a lot of films in a year. As a result of this break, we've seen some disruption in Hindi films as far as this year is concerned, also some bit of disruption in the mid-segment films. But we also believe that the bounce back will be very sharp. And the reason I'm saying that is that when you look at the Hollywood situation, when you look at the North America box office, the films which have released this year, and I'm referring to the mid-segment films like Puss in the Boots, which is an animation film, Creed 3, which came out recently, Megan, which came out recently, another horror film, A Man Called Otto, which is a very small specialty film, almost like an art house film, Cocaine Bear, which has no star cast to boast of, Scream 6, which came out this last Friday and has turned out to be the biggest Scream in the entire franchise. Like pre-COVID, this is the sixth Scream, and this is the best outing Scream series franchise has had. So the resurgence in the box office, especially in these mid-level films, the big, the tentpole films like Avatar, and the similar category of Marvel films or DC films, they were doing well in any case, but it's the mid-level films which were suffering because of this break in the habit. But those films are coming back in a very, very sharp manner in the North American market. We believe our market is ripe for a similar resurgence. It's a matter of time when you would start seeing a jump in occupancies as far as the mid-level films are concerned, as far as the Hindi films are concerned. And also the quantity of Hollywood films is slated for an increase later this year. So we don't believe it's, the discretionary spends, because our business traditionally has been recession-proof. We believe the business will continue to be recession-proof. In fact, if anything, it will grow more in times when there is, some sort of a financial crisis. People would need more escapism. People will tend to go out more with their families and friends. So yeah, that's what we would like to share.
Understood. This is very, very detailed and helpful. Thank you so much.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Pulkit Chawla from Emkay Global. Please go ahead.
Hi. Thank you for the opportunity. So first, on the screen expansion plan, how are you currently looking at adding screens in metro cities versus say tier 2 or tier 3 city? And is there some preference for some particular region as well, like you mentioned the south? Second, I think with the merger now complete, will you be looking to get more aggressive with PVR Pictures with a larger reach for you now?
Yeah, I mean, out of the 200 screens that we are looking at opening up this year, 44% are in the metros, and actually a majority of them are in the south. I think about 35% or 40% almost in the southern region, where the business remains robust in Tamil Nadu, Karnataka, Andhra, Telangana, and Kerala. There the business still remains very robust. Regional movies are doing well. There's a lot of focus of screen additions in the southern region. In tier 1, we have about 38% screens coming up, and between tier 2 and tier 3, about 17% screens are coming up. Of course, between both PVR and Inox expansion, we're also looking at some new cities that have yet not had a multiplex experience. It's India is a very large country and under-screened country, and we are looking at places like Patna. We're opening sometime soon, Ajmer, and some very small places in South India also, like Tirupur and Machilipatnam, where these are the places which are yet to see a retail and a multiplex revolution. So these are some new places both in South and other parts of the country, where we're also focusing on screen expansion. And the second part was PVR Pictures. Yeah, we're getting some good opportunities for PVR Pictures also. We are looking at scaling up both our English and Hindi and even regional business. English films, of course, we sub-distributed Everything Everywhere All at Once and The Whale, which won the Oscars just yesterday. We have a lineup of Lionsgate films for the whole year. We're releasing John Wick on the 24th of March, which is a very big franchise. Amongst many other English films, on an average, we release at least one film every 2 weeks. Hindi films, we've had a big hit in November with Drishyam 2, which is an all-India box office about 250 crores. And we're following that up now in March, end of March, 30th March, we have Bola with Ajay Devgn once again. And we're in talks with various other producers, Hindi and regional, for augmenting our local film distribution business as well. So there are a lot of opportunities coming our way.
Yeah, thanks. That's it from me. Thank you.
Thank you. We have our next question from the line of Preet Malde from Centra Advisors LLP. Please go ahead. Preet Malde, you are unmuted. Can you please go ahead with your question?
Yeah, am I audible?
Yes.
Okay. So the approach of Inox and PVR has been different historically when it comes to opening up new properties. Inox has more or less refrained from paying a high premium for premium properties, and PVR has not, if we look at it historically. So how will our approach be from now on when we'll start operating as a singular brand?
That's not entirely true. I think in the Inox portfolio also there's been a lot of premium offerings and products like Insignia. There's an Insignia in Mumbai, in Nariman Point. Metro Cinema is very premium. In Gurgaon, there's an Insignia which is very premium. So I think both companies have had a mixed bag of products and cinema classification. Going forward, I think we're looking at each and every city, each and every catchment within the city, the mall specifications where we are housed, the catchments around that mall, and then therefore looking at decisions of premiumization versus making a mainstream cinema. But I think by and large, we are looking at providing a very good high standard of cinema, regardless of
whether it's an Insignia format or a Lux format or the Director's Cut, which is a super luxury format. We're looking at providing a very good high standard of cinema, both in terms of interiors and experience. And we have many formats also, IMAX, 4DX, MX4D, Playhouse, Kidos, which we're looking at deploying at various cinemas across the country, current and upcoming as well, in order to make the experience, as good and as comfortable as possible for the patient.
I think you just misunderstood my question. I was not talking about premium viewing experiences, but all in all, properties that attract a higher footfall. PVR is ready to pay a higher premium for such properties, and Inox has usually refrained from it. If we look at it by EV per screen perspective, we can see the difference. So how will our approach be from now on? That's what I'm asking.
Okay, no, sorry. I mean, I think again going back, there were some properties by Inox also that are slightly higher, premium pay. And going forward, we have a very robust pipeline now. Actually, we already have about 160 odd screens under fit out, and going forward also we have 150, 160 odd screens that will be taking for handover sometime soon in H2 of next year. And I think, the market has found its level, so to speak now. And going forward, we are getting better deals and better developments to build these multiplexes at just market rates and reasonable rates, and nothing which is too high or too premium. Because I think these developers also realize that they want a good product and a premium product for their malls, and we're providing that, and providing the footfall that is required to irrigate the malls.
Okay, and the new screens that will be starting, how will they be branded? Will it be branded as Inox PVR or a specific Inox or PVR, or a PVR Inox combined brand?
So I think as of now, all the pipeline that we are executing over the next 6 months, because it's already under fit out, will open on an as-is basis. PVR screens will open as PVR, Inox screens will open as Inox. I think it is a new handover that we will take now, which will open 6-9 months later. There we will have the question of rebranding coming into play. I think we are deliberating on that. The going in position was to brand everything as PVR Inox. That's what we had announced when we did the merger. But to be honest, we need to think through the brand strategy as we go along. So, but at least in the near term, next 6 months, whatever is opening will open as is with the existing branding.
Okay, makes sense. Thank you so much.
Thank you. As there are no further questions, I would now like to hand the conference over to management for closing comments. Over to you.
So, thank you. I just wanted to thank you for taking your time for the call, and if you have any follow-up questions, you can write to us. Thank you.
Thank you. On behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.